Merchandise companies return merchandise from time to time, are granted purchasing or payment discounts for paying early, and allowed trade discounts if they purchase large quantities. Let's talk about all of that and how accountants record these transactions. When merchandise arrives, it is examined to confirm that it is satisfactory. Occasionally, though, the wrong goods are shipped, or items are damaged or defective. Purchase return is used when the business returns the goods. The supplier issues a credit memo for the return or allowance. The credit memo reduces the amount that the purchaser owes. A purchase allowance is when the purchaser keeps the goods but receives a reduction in the price of the goods. Purchase returns and allowances are entered in the purchases, returns, and allowances account, not in the purchases account. The purchases, returns, and allowance account is a complete record of returns and allowances. Business managers analyze this account to identify problem suppliers. Purchases, returns, and allowances is a contra expense under cost of goods sold. The normal balance of cost of goods sold is a debit. The purchases, returns, and allowance account has a normal credit balance. Here's an example of how Max Out Sporting Goods records purchases, returns, and allowances. Let's read it together. Max Out Sporting Goods received merchandise costing $4,760 from Modern Sportsman on January 15th with invoice number 1100 with freight charges of $360 paid by Modern Sportsman and added to the invoice. Some goods were damaged, and the supplier granted a $476 purchase allowance on its credit memo 103 of January 27th. This reduction in price reduces our accounts payable. That is why we debit accounts payable when we receive the credit memo, and we credit purchases, returns, and allowances. When Max Out Sporting Goods pays Modern Sportsman, we debit accounts payable for $4,644 and credit cash for the amount of the original invoice of $5,120, less the credit memo of $476 or $4,644. We've previously talked about net 30-day payment terms, which means that the invoice must be paid in full within 30 days. Merchandising companies, just like any other company really, are interested in receiving payment or purchasing discounts, not to be confused with trade discounts, though. Trade discounts are discounts that are typically granted based on the volume purchased. For instance, if you purchase 500 of this product, the price decreases by 20%. If you purchase 1,000, the price decreases by 30%. That's a trade discount. What are we talking about here, though, is a discount for paying early. A popular purchase or payment discount is 2% 10 days, which translates into this. The buyer can reduce the invoice amount by 2% if the buyer pays the bill within 10 days. There are other similar terms such as 310 or 110. They all have this in common, though. It's a discount offered by suppliers to encourage quick payment by customers. Just keep in mind that the 2% discount does not apply to freight, though. The freight prepaid by the supplier and added to the invoice. Let's look at an example. Max Out Sporting Goods received merchandise costing $3,000 from Modern Sportsman on January 10th, invoice 880, terms 210, net 30, with freight charges of $200 paid by Modern Sportsman and added to the invoice. Max Out Sporting Goods recorded the purchase as follows. We write the date into the date columns, purchases into the description column, and a debit of $3,000 into the debit column. On the second line, we debit freight in for $200, and on the third line, we slightly indent and credit accounts payable for $3,200. Max Out Sporting Goods paid the amount due after deducting the 2% discount on January 19th with check number 150. The amount due is $3,140, which is $3,000 minus 2%, or $2,940, plus then the $200 freight, for a total of $3,140. The payment is then recorded by debiting accounts payable for $3,200, crediting purchases discounts for $60, and crediting cash for the payment of $3,140. If there's a purchase return processed within the discount period, the buyer is entitled to take the cash discount only on the balance owed after the return. For example, purchase of $500 from Modern Sportsman on January 11th, terms through 10, net 30, with freight of $25 added on invoice to 9/10. A return of $100 on January 12th with credit memo 112, and the final payment on January 20th, check 149. The merchandise purchase of $500 with freight of $25 is recorded with a debit of $500 to purchases and a debit to freight in for $25 and a credit to accounts payable for $525. The purchase return below reduces accounts payable by $100 with a debit to that account and credits purchases, returns, and allowances. Why do we record this in a separate account? Well, it's really helpful for analysis of how significant returns and allowances are to your business. If your purchases, returns, and allowances are high, then you probably want to figure out if you should change suppliers. Now we're ready to record payment on January 20th within the 2% 10 days payment terms. First, let's figure out how much has to be paid. We take the original invoice of $500 and deduct the return of $100. Then we'll deduct the purchase discounts of 2% or $8, and finally add the freight. We record the transaction with a debit to accounts payable for $425, a credit to purchases discounts for $8, and a credit to cash for $417.